Just going to give everybody one more second to connect to the audio, and then we'll get started. Okay, well, it is 12:01. We're going to go ahead and get started. Good afternoon, everybody. This is Cash Flow 101. My name is Chris Hervochon. I am a CPA here in Bluffton, South Carolina, and I'll be presenting this webinar today on behalf of the Don Ryan Center for Innovation. So this is a little bit about me. As I said, I am a CPA located here in Bluffton. We've got a team of 3.5, and we've got clients that are located east to west across the United States, north to south, pretty much everywhere. And we specialize in helping small businesses grow their business. That's primarily what we focus on. And we have a specialty in service-based businesses, actually. So what we're going to cover today, we're going to cover a whole lot of ground. And, you know, being where we are in the world today, I know this is Cash Flow 101, but just being where we are with COVID-19 and the extenuating circumstances that a lot of small businesses are facing, we're going to cover some basic cash management considerations as well. And we're going to cover it, you know, not necessarily from how we normally would in normal times. It's going to be a little bit about how you manage in a crisis, and then also how you manage in normal times as well. And then of course, you know, the typical cash flow stuff. So what we're going to cover, number one, why you need cash, the 3 different types of cash flow and how you can read a cash flow statement, how much cash you should have in reserve, super important, especially now, how to measure your business's ability to manage cash flow, how to forecast cash flow. That's going to be probably a good chunk of this call, and ideas for fixing your cash flow. So relative to the forecasting cash flow, you all should have received an email from the Don Ryan Center, which included an Excel workbook, which will help you to forecast your cash flow in your business. You can actually even use it for your personal finances as well. Cash flow, you know, translates well from business to personal. But we're going to go through that workbook in pretty decent detail here toward the end of this webinar. If you have any questions during the course of the webinar, by all means, put them in the chat. I'll be monitoring the chat as we go. That's the best way to ask questions, and I'll be happy to answer those as we go along. Like I said, we are going to cover a lot of ground here, and there is there is a lot of nuance. So anyway, all right, what is cash? Cash is anything that is cash, so hard currency, and then anything that can be readily converted to cash. Good examples would be money market accounts, checking accounts, savings accounts, anything that can be readily converted to cash that has a known value. Investable securities, here's a good example. If you own stocks, you can convert those to cash, yes, fairly quickly. But the problem is that they don't have a known value, right? Bitcoin, same way. You can convert that to US dollars, but does not necessarily have a known value from moment to moment. So that's a little bit difficult. For the purpose of cash today, we're going to be considering cash to be anything that is actual hard currency and then anything that can be converted readily to cash. Very important distinction there. Why do you need cash? It's a way to pay for goods and services. There's only 3 ways to pay for goods and services. Number 1 is cash. Number 2 is debt. And then number 3 is the barter system. Bartering is good for some things. It does not apply to the vast array of services that you probably need in your business. You may be able to barter 1 or 2 services. You probably cannot barter the whole thing. Good example, in my business, we have a Zoom subscription. I cannot barter for that Zoom subscription. I've got to pay in cash or I've got to pay with a credit card. That's debt, right? The thing about debt is that it's always at some point in the future going to be paid with cash, or you're going to have to declare bankruptcy, or you're going to have to die. So there's really only one good way to get rid of debt, and it's going to be cash. It's why you need cash. Debt always turns into cash. Why do you need cash? Because you can only pay for certain things with cash. A really good example is your people. your employees. You can only pay for your employees with cash. You can't pay them via credit card. You can't barter with them. You can't pay them in seeds or anything like that. You've got to pay them in cash. Number two, your mortgage. A lot of business owners are in business because they want to get a benefit for themselves and for their family, some sort of a financial benefit that's going to last them, you know, either through their generation or multiple generations. One of those things is to finance your existence, right? So you've got to pay for food, you've got to pay for, you know, your kids' schooling, you've got to pay for clothes, you've got to pay for your mortgage. Mortgages are really hard to pay in anything except for cash. Yes, there are third parties out there. I do realize that. But generally speaking, it's pretty difficult to pay for your mortgage in anything other than cash. And then third, you need a cash reserve in your business. The only way to fund a cash reserve is with cash flow. Of course, you could take on debt. You could put the cash, you know, take the cash from the debt, put it in the reserve. Yeah, that's fine, but you still have the debt. Remember, we just said that the only way to get rid of debt really is through cash at some point in the future. That's kind of the crux. To kind of further the point about employees, here is a section from the South Carolina Code of Laws. The link's down there at the bottom. You can go check it out for yourself. And I highlighted the relevant portion here in the middle. Every member in the state shall pay all wages due in lawful United States money or by negotiable warrant or check bearing even date with the payday. What that means is you've got to pay your employees in cash. By law, employees, cash has to happen. So cash flow, or having cash on hand, super important. There are only certain expenses that you can pay with cash. Got to have cash. Hopefully we've hammered that point home at this point. Here's an example of a P&L statement, profit and loss, income statement, same thing, okay? What we're trying to get to here is what is the difference between net income and cash flow? Your net income, that's that bottom number there. It says 122,200. That is not necessarily the same thing as cash flow. And why we're going to talk about that, accrual accounting. Two bases of accounting, accrual accounting, cash accounting. Accrual accounting records the transactions when they happen, when the economic activity happens, not necessarily when cash changes hands. What is cash accounting? Cash accounting is when you're recording the transactions in your general ledger, in your books, QuickBooks, whatever that's going to be. And that is when the transactions are recorded, is when cash changes hands, either coming in or going out. Why that's important? The net income on a cash basis P&L is going to roughly approximate what the cash flow is. Now, there's other considerations, of course. If the business has debt and cash is going out to pay that debt, it's not going to be reflected on the income statement, okay? So generally speaking, assuming a business is cash basis, meaning cash basis financial statements, and assuming that it's low debt, you know, things that are, it doesn't have other things that are taking up cash, the net income of that business is going to very closely approximate what the cash flow from operations are of that business, okay? Not the same thing for an accrual basis income statement. So accrual basis, remember, is when we're recording transactions when the economic activity happens. That doesn't necessarily mean that that's when the cash happens. Here's a good example. You do services for Bob. You know, let's just say you have a landscape company, you do services for Bob on Monday, and you send Bob an invoice on Tuesday. Bob doesn't pay the invoice for 30 days. Well, you record the revenue on Monday, but you don't receive the cash for another 30 days. So there's a big gap there in an accrual basis accounting system. We've got to be aware of that when we start to think about cash flow and reading our financials in a way that's going to allow us to, number one, understand what our cash flow is, but then number two, be able to read our financials and forecast cash and manage cash and all of those things. Okay. So here is an example of a cash flow statement. There's generally three main financial statements to a financial package. Number one is your P&L, number two is your balance sheet, number three is going to be your cash flow statement. Your cash flow statement is going to tell you where cash is coming from and where it's going. Okay, there are three different types of cash flow. At the top, net cash flow from operating activities. In the middle is net cash flow from investing activities. And then number three is net cash flow from financing activities. Net cash flow from operating activities is by far the most important component of a cash flow statement, because this tells you how the operations of a business are generating or not cash. Super important. Remember, we need cash. What we see here is an example of the indirect method of cash flow from operating activities, and I'll get there in a minute, but as you'll see, it starts with net income. We take the net income from the P&L, we add back depreciation expense. Depreciation is a non-cash expense. So you buy a piece of equipment, you depreciate it over time, which means that you expense it over time. That's not necessarily when the cash moves. You bought the equipment up front, so let's just say you bought a piece of equipment for $100. Cash goes out the door, okay? $100, that's where the moment that you bought that piece of equipment, it's gone, okay? That's when the cash moves. But on your P&L, you're gonna show it as maybe $10 over 10 years. So you're taking that expense incrementally. It's a non-cash expense at that point. We need to add that back, okay? Adjustments to net income, that could really be anything. That's kind of a catch-all. Decrease or increase to accounts receivable. That goes back to our example from a couple of minutes ago where you did landscaping service for Bob. You invoiced him on the next day, and then he paid sometime later. You're gonna hold AR in your business. That AR is gonna fluctuate depending on who owes you money, who owes you how much money over a period of time. As we collect cash, that may not be when the revenue was recognized, but certainly it's when the cash is coming in. That's cash flow from operations. If it's AR related, we're going to add that back here, or we're going to have a decrease if AR increased over the period of time. We're going to decrease that, or we're going to basically subtract that from revenue. Same thing with liabilities. This is the exact opposite of AR, is when you incur expenses, but you're going to pay them at a later date. The expense happens, on Monday, and then maybe you don't pay them until Friday, or pay them a month later, a year later, whatever it's going to be. Again, the cash is going to move at some later date. Increase, decrease in inventories. If it's an inventory-based business, retail is a good example of that. Manufacturing, also a good example of that. Any increases or decreases we're going to apply here, and then other operating activities. Again, that's going to be just another kind of catch-all. Investing activities, really good example. If you're holding cash in your business and you're investing it either in marketable securities or you're investing it in CDs or money market, whatever that is, cash that comes from those activities, that's going to go in this section. And then finally, cash from financing activities, that's going to be your debt. Okay, if you're taking on debt to buy equipment, if you're taking on debt to buy a building, if you're just taking on debt for operations, that's a financing activity. That's going to be cash in. What you should realize about the bottom portion of this cash flow statement is from cash from financing activities is going to correlate with debt. We're going to see an increase in debt on the balance sheet, generally speaking. Okay, so that is how to read the cash flow statement. Super important. I cannot stress enough, the biggest piece of this is going to be cash flow from operating activities, because that's going to tell you how well your business is actually operating and generating cash. Profit is great. It's awesome. Cool. But you need cash to come from that profit. If it doesn't turn into cash, it's basically useless, right? Because we can't then pay our liabilities. We can't pay our mortgage. We can't pay our employees. It's got to turn into cash. Okay. Two ways to show cash flow from operations, and I alluded to this earlier. There's the direct method and the indirect method. The direct method, basically, you're just listing the number of things that are contributing to cash from operations or subtracting from cash from operations. Pretty straightforward. It doesn't start with net income. It's just adding in you're just starting from scratch, and then you're adding in or subtracting the things that generated cash from operations. The indirect method is an example of what we just saw. So we're starting with net income, and then we're adding back or subtracting the things that were not cash related when we arrived at that net income number. They should get you to the same number, but what you should realize is that your accounting software may present your cash flow statement in a different way. It may present it in the direct method or the indirect method. You may have the option to see the direct method or the indirect method. It's just a presentation technique. It's not necessarily a calculation technique. It's a presentation technique. When you're looking at financials from publicly traded companies, or when you're looking at comparative financials, you should just understand what you're looking at from a presentation perspective and then apply that back to your company. Okay, we're gonna sort of change gears here, and we're gonna talk about cash reserves. Cash reserves are not cash flow, but they are super important, especially now during this COVID-19 period of time. We talk to our clients at least twice a year about cash reserves. Now it's a little bit more of a hot topic, and it needs to be a little bit more frequently discussed and frequently looked at. because where we are right now, it's not so much about funding growth or managing growth or thinking about growth. It's about getting to the other side of this event that we're experiencing, basically. Cash reserves are what's going to allow you to do that. So cash reserves, normally speaking, serve two main purposes. Number one is to fund the growth of the business. If you have enough cash in the business when you're thinking about hiring somebody, an incremental employee, or you're thinking about making a large, equipment or machinery purchase, or you're thinking about buying yourself a building, you've got to have some sort of a cash reserve for a down payment, or to buy that, or to pay that employee, or to pay the stuff to onboard an employee. You've got to buy a computer, you've got to buy software, all that stuff. That should come out of cash reserve. If it doesn't come out of cash reserve, it's got to come out of debt. When it comes out of debt, number one, you're giving yourself another liability, but also number two, you're going to have an interest expense. So it's going to, by its nature, make the business less profitable, at least in the short term. Okay. So funding growth, one of the reasons why we have cash reserves. Number two, it's a safety net, which is what we're talking about during this COVID-19 period of time. We're seeing right now businesses where their entire revenue stream basically evaporated overnight. We're a month into this now. Some businesses are fine, totally fine. They can operate this way in this environment, and that's great. Some businesses saw some kind of period of normalcy after this quarantine period, and they're seeing this gradual decline. That's not good. That's why you need cash reserves. And then some businesses, they just had to shut down overnight, basically. That's why you need cash reserves. It's a safety net for your business, but it also helps to fund growth. It's super, super important. How much cash should you have in reserve? Generally speaking, we recommend 2 to 6 months of fixed expenses in reserve. You're going to see, if you just Google this topic, you're going to see varying recommendations. They're all, generally worthwhile in some way, shape, or form. You might see, 1 to 5 months. You might see 3 to 6 months. They're 6 of one, half dozen of the other. Basically, you need to have some period of time of fixed expense in reserve. The other thing that you might see actually is to have 2 to 6 months of revenue in reserve. I personally like to go based on fixed expenses. Reason why, a lot of our small business clients are S corps, and as an S corp, you have to take reasonable compensation, which means that the owner is going to be on payroll. That's going to be a fixed expense. So when we talk about fixed expenses, it's generally covering the owner's payroll. So the benefit that they're taking out of the business so that they can pay themselves, so that they can go buy food for their family, they can pay their mortgage, all that good stuff. If we're counting fixed expenses, it's generally going to cover that, some benefit out to the owner. So it kind of removes the need to have that revenue component. I'm a little bit down in the weeds right now, but just know that there's multiple ways to do this. This is one of the ways that we recommend. We recommend 2 to 6 months. It's not a hard and fast rule. Ultimately, you've got to, do what makes sense for you and your business. This is just one way to look at it. I know 2 to 6 months, that's super broad, right? That's not helpful. Well, because the question is, well, Chris, should it be 2 months? Should it be 6 months? How do I know? Good question. So this is how you can be a little bit more precise. This is a process that we've refined in our firm over the past year and a half. It's by no means perfect. Again, this is just what we think, and this is what we have found to be helpful for clients. In researching how we can make this process better, what I've come to realize really is that there's no real formula to determine what's right. Basically, so there's really no good way to quantify it. Yeah, there are formulas out there that you might find if you dig really, really deep into corporate finance literature, but you're going to have to really, really dig. And for the most part, those formulas are they're more applicable to larger publicly traded companies. That they're not necessarily going to be very well applied to small businesses, really, which is what we're concerned about. The vast majority of businesses in America are small businesses. That's what we're concerned about. So here's how you can be a little bit more precise. It's a 9-question questionnaire that you can do this by yourself. It's fairly easy to calculate. And really what this is about, what I call it anyway, is the Can You Sleep at Night Index. Basically, it's a way to look at qualitative questions and then quantify how much cash your business should have in reserve, because that's going to ultimately depend on whether or not you can sleep at night. If you don't have enough cash in your business, if you're struggling to make payroll, if you know that you can't fund the growth that you want to fund, that's going to keep you up at night, theoretically, or probably. You need to have enough cash in the business, in reserve, so that you can sleep comfortably and comfortably at night, knowing that you're going to be able to fund these ambitions that you have for you and your business. Okay. So number one, the approximate dollar figure of how much fixed expenses you have per month. Okay. So for this example, let's just say it's $10,000. Okay. You can find that by running your P&L, take the average over the last 12 months, 6 months, whatever it's going to be. Whatever your run rate is approximately expected to be going forward, that's what it should be. Okay. And then now we get into the qualitative stuff. So is your revenue project-based or is it recurring? You're going to rank all of these next 8 questions on a scale of 1 to 5. If it's project-based, it means it's volatile. You rank it a 1. If it's recurring, it means it's steady, it's repeatable over time. You know exactly what it's going to be. You rate it a 5. Number 2, how well does your business collect accounts receivable? When you send somebody an invoice, is it sitting out there lingering, waiting to be collected for long periods of time? Are your clients slow to pay you? Do you not have good processes in place to get that done? What does that look like? If it doesn't look good, if you've got tons of receivables sitting out there all the time, if you're constantly wondering whether or not your clients are going to pay you, if for the work that you've already done, then it's number 1. You know, if you have no receivables in your business, great, that's awesome, good for you. You have very little AR, then you're probably going to lean toward 5. There's no right or wrong answer. It's just how you feel about this particular process. Okay. How do you feel about your business's revenue growth? So how has it been trending over time? Is it awesome? Then it's a 5. Is it not good? Then it's a 1. How do you feel about your revenue pipeline? So this is all the stuff that's looking forward. A month ago, probably looked pretty good. The economy was growing gangbusters. If it looks awesome, it's a 5. If it doesn't look so awesome, it's a 1. Okay. How do you feel about your client diversification? What this gets to is a risk management question. If you have one huge client who is a large majority of your revenue, that if they left tomorrow, you basically be out of business, then you should be at a 1. If you've got a ton of clients paying you and really the loss of one client wouldn't affect the business, and you're comfortable with the amount of diversification that you have, then you should be a 5. One of the interesting things here, especially in the way that we advise service-based businesses, is that niching, generally speaking, is a great way to go. So you have one industry vertical. So for us, it's service-based businesses, in particular marketing and creative agencies. Okay. What happens when that vertical isn't doing so well? So if you're in the food and beverage vertical, especially here in the low country of South Carolina, right now, that's hurting you. This is like a really weird time where client diversification could actually be hurting you. In normal times, if you've got a ton of different clients and you've got a really good industry niche, so that means that your prices are generally higher because you're the expert in that industry, then you're great. Your diversification, even though it's in one vertical, is still really good. That might not be the case now. So you have to kind of think about that if you're going to do this exercise today. If you're going to do this exercise in 6 months or a year from now, the way that you're going to ask yourself that question is going to be a little bit different. So just throwing that out there. Okay, moving on. How do you feel about your current staffing levels? Do you have enough people? Do you need more people? What's that going to look like? If you need more people, if you don't feel so good about how you're currently staffed, you're going to be at a 1. If you feel really good, we're not going to need more people, we're in a good spot right now, you're going to be at a 5. How do you feel about upcoming investment needs of your business? If you're not prepared, you're going to be at a 1. If you are prepared, if you know exactly what you're going to need and how you're going to finance it, you're going to be at a 5. And then finally, how do you feel about your personal liquidity outside of your business? Do you absolutely positively need your business to be kicking off cash? Do you need it to be functioning at a high level so that you personally can survive? Well, then, maybe you don't feel so good, you're at a 1. If you've got personal wealth, if you've got personal cash, if everything's fine, if you could survive for several months without the business doing all that well, maybe you're at a 5. All right, so we've gone through that entire exercise. We've asked the 9 questions. We've talked about what they mean. We figured out how to score them. All right, great. So what does that mean? Why do we care? All right, so now we're gonna get a little bit math nerdy here for probably the next couple of minutes. So I apologize, this is not calculus, I promise, but it is math nonetheless. So what you're gonna do, you're gonna total up that total score. So the highest possible score you can have is 40. So 5 times 8. Okay. The lowest possible score you could have is going to be 8. 8 times 1. Okay. So you're going to do 7 minus that total score divided by 8. So total score divided by 8. Let's say the highest score is 40. Let's just say you scored 34. Divide that by 8. I think you get 4.25. So 7 minus that number, 7 minus 4.25 is going to be 2.75 times the average fixed expenses. So that example down there is actually down there at the bottom. 7 minus 34 divided by 8 times 10,000. Your cash reserve target is going to be 27,500. So 34 divided by 8, 4.25. 7 minus that is 2.75. 2.75 times 10,000, 27,500. Hopefully I've not confused the bejesus out of everybody. If you want, take a screenshot of this slide, save the formula. And actually, if anybody wants the slides from this, happy to provide those. Just shoot me an email after this, or shoot the kind folks over at the Don Ryan Center an email, and they'll send you over the slides. So we'll get those for you. But that's a really important thing to kind of understand as you're trying to manage your business, as you're trying to manage the cash in your business. What does the cash reserve need to be? And then the cash reserve needs to be funded by cash flow, really. For a normal, healthy operating business, it needs to be funded by cash flow, which is why cash flow is super important. It's got to fund the reserve, it's got to fund the operations, then it's got to fund the growth of the business ultimately. All right, so now we're going to get more math geeky. So stages of the cash conversion cycle, and there's 3 components to the cash conversion cycle. The cash conversion cycle is super important. You should measure and manage the cash conversion cycle as a whole over the course of time in your business. And then you should also manage the 3 components of that separately and measure them over time in your business. There's 3 components here: days inventory outstanding, days sales outstanding, and days payable outstanding. Days inventory outstanding basically is the amount of inventory that you have, the number of days of inventory that you have sitting in the business. Okay, the way that we calculate that, beginning inventory plus ending inventory divided by 2, that's your average inventory. So 1/1/2020 inventory, 4/14/20, which is the day that we're doing this webinar. Add those together, divided by 2, that's your average inventory for the year. Okay, that's how much you've been holding for the course of the year. Divide that by your cost of goods sold. That's what COGS is. COGS is cost of goods sold. That's the inventory that's actually being expensed through the P&L. And then multiply that by 365. So that's the number of days that you have in inventory. Days sales outstanding, the calculation is fairly similar. And what this is your AR, your average AR divided by your revenue per day. So how much AR you have basically per day. Beginning AR plus ending AR divided by 2, divided by your revenue per day. Days payable outstanding, same thing as AR, it's just AP. And I have a typo right there in the beginning of that, so I'm sorry. But it should be AP. Good article on this. It's linked down at the bottom, Investopedia. Investopedia generally does a pretty good job of breaking down corporate finance concepts and personal finance concepts in layman's terms. So I recommend that as a good resource for folks. But there is a good link here which breaks all of this down. Again, super important to manage all 3 of these separately, measure them separately, and then keep track of them over time, because that is what's going to move the cash conversion cycle. The cash conversion cycle basically just takes those 3 components and just adds them together to get an aggregate of time. Okay, days inventory plus days sales minus days payable outstanding. Lower the better for the cash conversion cycle. And lower number, basically what that's going to mean is that you're converting inventory and sales into cash rather quickly, and that also you're paying payables slowly, which is why it's minus days payable outstanding. That is pretty much all I've got on this. But again, cash conversion cycle, very important to kind of understand what that is, manage that in your business. That's one way that you can actually measure how well you're doing at managing cash in your business, how well you're doing at managing the activity of your business relative to cash that is generating or using. Okay, and then finally, this is a really good chart, I think, about the cash conversion cycle. It takes it from those wonky, nerdy formulas that I just showed you, and it shows you what it actually looks like in practice. So up front during your process, you're going to have some sort of an expense. Oh, the other thing I forgot to mention, and I apologize, I'm going to skip back. To do this for a service-based business, just remove that days inventory component, and it's going to be days sales minus days payable. Pretty simple. But what this chart is going to show you is how this works in practice. So on the front end, you're going to have some sort of an expense. For a service-based business, it's going to be, maybe a contractor or some sort of service or software that you have to buy in order to deliver some sort of a service to your client. For a retail type business or manufacturing type business, you're going to have to buy raw materials, you're going to have to buy inventory. There's going to be some sort of an expense up front, which is generally going to be a payable, because the expense is going to happen. You're going to get the services and the materials up front, and then you're going to pay for them at some point later. Some point thereafter, your product or service is going to be sold. You've got the raw materials or the raw inputs. You've converted that into some sort of a product or service. You've then sold it, and then you're going to collect that revenue. So that cash conversion cycle is going to be this bottom right quadrant right here, where cash is actually going out the door and cash is actually coming in the door. Clients and vendors or suppliers retrospectively. Okay. Okay. Other metrics that you can track to measure how well you're doing with cash management. Average receivable collection days by client, super important. I think this is a really good measurement for businesses to be looking at. A lot of businesses really just look at their AR in buckets. So 1 to 30 or current, 1 to 30 days past due, 60 to 90 past due, over 90 past due, or they'll look at it just in total. When you really get down to the client level, you kind of figure out, is this client habitually paying us late? Are they a good client for us? How is their delay in payment affecting our business? You can start to ask those next level questions. So it's really great to get down to that level of detail and have those client specific discussions. I think it's very, very helpful. Your quick ratio, this is also known as the acid test ratio. You'll see that, out in the wild. They mean exactly the same thing. And what that is quick assets divided by current liabilities. Now, what's a quick asset? A quick asset is anything that is cash or readily converted to cash. Remember, we had that conversation about a half hour ago now about what is cash? Quick assets, same thing. Anything that can be readily converted into cash in a very short period of time, liquid assets, basically is what we're looking at. Minus current liabilities, these are things that you're going to pay inside of a year. That's a really good measurement of liquidity. There's also another ratio out there that's not listed here. It's called the current ratio. That's current assets divided by current liability. The quick ratio is kind of the next iteration of that. The current assets, that's going to include things like inventory, things like receivables, things that maybe aren't necessarily as readily converted into cash or can become cash. The quick ratio is really the better way to measure liquidity. It's definitely a next level. Receivables to working capital, accounts receivable divided by current assets minus current liabilities. That's basically just saying what percentage of your working capital is your accounts receivable. Super important to measure that and keep track of it. Inventory to working capital, same type calculation. We're basically just taking inventory as a percentage of working capital. And probably my favorite on the list is the defensive interval. Super important, especially now during this COVID crisis. That's going to be your quick assets divided by your annual cash operating expenses divided by 365. So what exactly does that mean? That means your average operating expenses per day, how much you are going to incur to keep the lights on, and then how many assets or how much assets in dollar terms do you have in order to fund that? And what this is going to tell you is just the number of days you can survive with zero revenue, which is a super important calculation nowadays, and something that we're going to talk about a little bit later when we forecast cash and talk about forecasting cash. But really great measurement. The other thing that I'll say about all of the metrics that are in this on the slide, they're great by themselves. If you measure them over time, you can start to see trends and you can start to understand how you're managing the business well or not well in some cases. But you really need that next level of context. That next level of context is going to be comparing your business or yourself to the industry. A couple ways you can do that. Industry data is available through services like RMA or ProfitSense. You can find it out there in the web. The IRS does ratios every so often by NAICS code, and it's basically the code that tells you what industry you're operating in. If you don't know what your NAICS code is, your accountant has put that together for you, and it's either going to be on your Schedule C or it's going to be on your 1120S if you're an S Corp, or on your partnership return. Regardless, it's going to be somewhere on your tax return. You're going to see an NAICS code, and that's going to tell you what industry you should be comparing yourself to when you go and pull this data. You can find this data from, industry publications or trade journals, or it's all over the place. One thing I'll mention about that: just use a consistent data source. That way, you're going to know that the population of data that they're drawing from is going to be at least a little bit consistent, and you're applying your situation consistently to that consistent data set. It's going to be much more of an apples to apples. No industry comparisons are going to be perfect, but you want to get yourself as consistent and as much of an apples to apples comparison as you possibly can, because that's going to provide you with more context to understand, is this good, is this bad, not good, not bad, where am I underperforming? It just kind of helps facilitate that conversation that you're going to have with yourself or with your advisors. Okay, now we're going to get into the nitty gritty. Forecasting cash. Why is it important? Super important to know where the sources and uses of cash are in your business. Yes, the cash flow statement is great, but we want to see over time, preferably by day, how we're going to use cash and how we're expecting to get cash on a probabilistic basis. And we're going to marinate on that for a second. I'll get to that. When we forecast, we can kind of look out into the future and inform ourselves of when and where there might be problems, which is really what we're trying to figure out. When is this problem going to occur or not? How good are things going to look? At what point am I going to have a full cash reserve? At what point am I going to be able to hire a new employee? At what point am I going to be able to invest in this new process or this new equipment or this new software, whatever it is? It's super important to look forward on a consistent basis. So right now, what we're telling clients is that you want to be forecasting cash on a weekly basis, because the world is just changing so fast that our assumptions need to be changing very, very fast. And our set of circumstances is just rapidly changing. So we need to stay on top of that and try to figure out when the problems are going to occur before they do. Generally speaking, though, monthly is good. There's nothing wrong with monthly. The more frequently you can do it, the better. If you can automate this process in your business, that's awesome. Congratulations. That's kind of the pinnacle of where you want to be. But super important, because it helps you to identify problems that are going to happen in the future. And what you want to do when you go through these forecasts is you kind of want to save your work. So you want to know, this is what my forecast looked like last week. This is how it's changed. This was right. This was not right. We were off by, whatever. Go back and kind of see how you did, because then that's going to help you become a better forecaster going forward. And it's also going to provide context on, what has changed and what you need to do out into the future in order to affect your situation. How far into the future should you forecast? Depends. Terrible answer, I know, but that's reality. Depending on how your business operates, you may be able to forecast further into the future. If you've got very sticky clients, if you've got very long-term contracts that just, it's hard for your clients to fire you. It's hard for, them to kind of go away. If you're thinking about like government contracts, things like that, things with long delivery cycles, airplanes, heavy machinery, that sort of stuff. You can kind of forecast pretty far. If you've got recurring revenue, recurring clients that have been with you for a long time, service-based business, that sort of thing. If you're a landscape company that does really good work and you've got a consistent client base, you can forecast pretty far. You know what the seasonal changes are going to be. You know how that's going to impact your business. You can go pretty far. And things that might vary are going to be, things like employees and things like that who may come in and out of your business. But you should know pretty close, what that's going to look like. If you are in a 100% project-based business, the amount of time that you can go out to the future to forecast is going to be much shorter. Okay. It's only going to be as good as the pipeline data that you're able to bring in, or, as good as, if you're using contractors in that project type business, that's certainly going to be one of those things very difficult to forecast. You don't know what their availability is going to be. There's just a lot of variables there in project type businesses. So the answer here is don't know, depends on your business. The further you can go, the better. Okay. But that's also why it's important to measure how well your forecasts are doing, because if you're going out into a period of time where you're just too far, you really just don't have the visibility in your business. You're going to determine that pretty quickly after you've gone through a few iterations of forecast, because you're going to see, hey, look, I'm going out 100 days in my forecast, and past 90 days, I just have no idea, no clue. Well, then maybe you should switch to a 90-day forecast. But that's why you need to track your progress over time. That's why you need to keep track of how well you're doing. So we've talked about it a lot, and we're going to dive into the forecast template that I passed out via the kind folks at the Don Ryan Center. And we're just going to walk you through this fairly quickly, because I do want to leave time here for questions at the end. And of course, if anybody has questions as we go through this, by all means, please let me know. I am taking a look at the chat here. So this is the first tab. It's got the instructions over here to the right. I'm basically going to cover this. Anything in yellow is what we want to populate. Okay. So start date today. We're going to start our cash forecast on today for 14/20. Easy enough. Minimum balance threshold. This is going to tie into that cash reserve that we calculated a little bit earlier. So, in that example that we used earlier, it was 27,500. These are weird times. So maybe that minimum balance threshold is 10,000. Maybe it's 5,000. Maybe it's 20. Whatever it is, use whatever balance threshold is appropriate for you and your business at the time. It's not going to be probably that most awesome cash reserve that we identified earlier, but it's going to be some variation of that. At this period of time, what we're just trying to do is get through to the other side. Okay, get through to the other side. What could this minimum balance be that's going to make you that's not going to make you terribly uncomfortable? It's not ideal, I know, but it's going to be okay. That's what we're looking for. That's the number we're looking for. So let's just assume here for this example, 10,000 bucks. We're going to list all of our bank accounts in this space here. So let's just assume that this particular business has two accounts, a checking account and a savings account. Let's just say right now the current cash balance is 25,000. Let's just say the savings account is 5,000. When we're forecasting the cash flow, especially where we are right now, I don't really care that there's 5,000 and 25,000 or what the split is. If you're managing your cash correctly in your business, you can move money between these two accounts pretty fluidly. Really, we only want to be listing accounts here where we can move money in and out, between these accounts. We've got a business that has 6 different operating entities. They had 6 of their 6 accounts listed here. We just want to know overall total picture, whether or not we're going to have a cash problem. We can, if we've set it up correctly, we can move cash between the two in an absolute emergency, not a big deal, right? So we're not terribly concerned with what account the cash is coming into and out of. We just want to know about the total cash balance, really, for the purpose of this exercise. And then here, this is a calculation. This will give you the date the threshold is breached. So, and we're going to go into the details here. But what this model is showing right now is that the cash balance of this business is not going to get below $10,000 until July 1st of 2020. This is a 150-day cash flow forecast, which at this point gets us out until about the middle of September or so. Depending on what you think about the current COVID crisis, pandemic, whatever you want to call it, and how long that's going to last, or how that's going to impact your business, how long that's going to impact your business for, that may or may not be enough time. When I put this model together, it was late-ish March, and 150 days was going to get us through into roughly August. And what we've been telling clients is, plan for this to go through July. Whether or not July is a good number right now, July 31st, don't know. Depends on kind of your read of the news. And like I said, things are changing very, very rapidly in today's world. So this is something that you want to stay on top of and do this fairly frequently. So that's how you enter the cash into this model. Okay. The model is kind of sort of built in QuickBooks Online parlance. So there's a clients tab, which is, customers in QuickBooks Online. There's a vendors tab, which is vendors in QuickBooks Online, and employees is employees. Okay. By clients, we mean any cash inflow that's going to come into the business. That is where this goes. So this could be clients, yes, but let's just say, for example, that you're going to get one of those PPP loans or an EDL loan. That would go in here as well, and you just put, due from federal government PPP loan. Let's just say it's definitely going to be, well, maybe one time, maybe not, who knows. Let's just say that you're going to get this in, I don't know, a week from now. So that'd be 4/21/2020. And let's just say it's going to be 15,000. 15,000. Okay. If we go back here, we'll see that now that bumps our cash threshold breakage out until August 1st. So it buys us basically a month at a time. But that's how you would add this in. Okay. Anywhere that cash is going to come into the business, it goes here. So we've got projected client 1. This is a project-based engagement. Let's just say it's going to be one time on the 24th of April. It's going to be $10,000. Now, favorite client number 1, they pay us recurring weekly on Friday, $250. And favorite client 2, they pay us recurring, but it's monthly, and then it's on the 1st of every month, and they pay us $500. And then we've got a huge project sitting out there, mid-May, $6,000. It's going to happen one time. So these items are going to be recurring. You're going to see these repetitively in the cash flow forecast. The other items, you're going to see them one-time items in the cash flow forecast. Vendors works exactly the same way, except for this is cash going out the door. Okay. So you're going to list your vendors here in the vendor column. Either they're one-time or recurring. Let's just say you have a software subscription that's going to be recurring. It's going to happen monthly. It's going to happen on some day of the month, repetitive, that you're going to know what that is. If you've got project work, when that's going to need to go out the door. So that big project that we have coming out on the 15th, we've got one vendor. We're going to have to pay them one time at the end of the month. It's going to be $500. And then beginning of the next month, it's going to be $1,500. That's the cash that's going out the door. This isn't just vendors. This isn't just contractors. It's any cash outflow. That's where it's going to go. If you think about QuickBooks Online, if you're a user of QuickBooks Online, vendors encompasses not just vendors, but it encompasses contractors and any other sort of provider where cash is going to go out the door, where it's going to be some sort of expense. Employees gets just a little bit trickier. Now we've got our owner's payroll here. Let's just assume this is some form of an S corp. They pay themselves monthly on a recurring basis on the 1st of every month. Your gross amount is going to go here. FICA, that's 7.65%. That's standard across the board. No need to change anything there. Employee benefits. This is a formula. On average, last I looked at the Bureau of Labor Statistics, it was about 25% was employee benefits. So you'll see in here in this formula, it's 25%. You can change this super easy. Regardless, it's in here as 25%, and then it calculates your total pay. Your total pay is what's going to flow to your cash forecast. This employee here, employee number 1, they're recurring. They get paid every single Wednesday, $800. Employee number 2, they're a little bit trickier. Okay, we see that they're listed here 9 times as one-time payments. But you'll see over here in the dates, they're getting paid semi-monthly, so twice a month. The formulas get really, really tricky when you're trying to do, if we were trying to have semi-monthly or bi-weekly in this particular column, the formulas get really, really tricky. I built this model in a way that a small business owner who doesn't really have a whole lot of experience with Excel could understand and could manipulate themselves because it's just helpful to get through this crisis. So if you have semi-monthly, if you have bi-weekly, you're going to have to list them separately with separate dates right here, like we did with employee number 2 as one time. Okay, that's just a little bit of a nuance. And it does get a little bit tricky if you've got a lot of employees. I've got another business that we did this for. If you've got 98 employees, and they pay them semi-monthly, this particular sheet ended up being something like 1,200 rows or something like that. It gets a little bit out of control, but it's easier, I think, to manage it that way than to manage what would be super complex formulas. That's why it's built this way. What that's going to give you, So we've got our beginning cash balance here that comes from our first tab, which is the sum of this $30,000. Okay, that's our starting cash. It takes all of our revenue that comes from our clients tab. It takes our expenses that comes from our vendors tab, and it takes our payroll on every single day for the next 150 days and tells us what our ending balance is. So if we remember, after we added in that $15,000, which is actually right here from the PPP loan, just as an example, we'll see that the threshold doesn't get breached until we get all the way down here when we have an ending, a forecasted ending balance of $9,911 on August 1st. And then you'll see the X's over here in this column, going forward. If we just scroll a little bit further, we'll see that we actually totally run out of cash here on September 1st with the September 1st payroll run. So that's a problem. What this has now identified is we have a problem that's forthcoming on September 1st unless our assumptions change. Why does that matter? That matters because now we can start making decisions based on, hey, at some point, one of these employees, do we need to furlough them? Do we need to put them on unemployment? What's that going to look like? How is that going to impact our forecast? Does that help us get through? We need to look at our vendors and kind of dig into the detail here. Do we really need this vendor? If we remove them, what does that look like? Not only for our ability to generate revenue, but what does that look like for our cash flow situation? Same thing with clients. If we lose clients, what's that going to look like? I would not put any revenue in a cash flow forecast that you do not think has at least a 75% probability of coming true on that certain date. Okay, 75% is like the rock bottom. If you want to be more conservative, go up to 80 or 85%. If you want to be less conservative, by all means, but tread lightly. You can go below 75%. 75%, that's a good number though. If you're not 75% sure that revenue is going to happen, don't include it, because then that's going to make your forecast probably just too aggressive. Certainly too aggressive for my blood. But that's the cash flow model. Does anybody have any questions on that? I know we're kind of getting toward the end. I've got some wrap-up items that I want to cover, but I want to make sure that everybody's questions about forecasting cash flow are kind of covered there. I don't see any questions now, but if you have them, by all means, please type them in. So we've done the forecasting. Quick tips to fix your cash flow and fix it now. Put processes in place to follow up on receivables. Automated is better. You can get software here. Bill.com is a good option. QuickBooks, you can send follow-ups. They're not automated. Zapier, you can automate your AR process a little bit with Zapier. Automated is better than not, because number one, it's awkward to follow up with clients and say, hey, you're going to pay us ever. It kind of takes that awkwardness out of it. If an email gets sent that says, hey, this is an automated message, your invoice is past due. That makes it a little bit less awkward. It takes that pressure off. That's one of the biggest pieces of pushback that we hear from our clients, is that they just don't like having those awkward conversations. Fair enough, I get it. Try to put processes in place that take that out of your purview, so to speak. Things that are super old, get yourself a collections agency or outsource that AR process, because that's free money, and at some point that free money becomes not your money. If you've done the work, if you sent the invoice, that's your money. You should collect on that. Once it gets to the point where it's super old, you can just basically write that off. It's not your money anymore. It's a loser, right? You got to write that off. It's actually an expense. Okay, revisit your payment collection methods. You can do cash. Are you doing credit card? Are you doing PayPal, Venmo, Bitcoin, all the various types of collecting payment? The idea is that you want to make it as easy for your clients to pay you as possible, because ultimately that's going to turn into cash for you. Even if your clients pay you in credit card, that's going to turn into cash for you once the payment processor has done their thing, and they're going to deposit cash straight into your bank account. So that's what we're ultimately looking for. Make it as easy as possible for your clients to pay you. If that means going from paper invoices to online invoices, whatever that is, think about how your clients like to interact with you. Think about how your clients like to operate, and then do that by all means. Revisit your contract terms. Are you taking enough deposits up front? Are you auto drafting on some sort of a cadence? Like, for instance, if you're that landscaping company, you could auto draft on the 15th of the month, you could auto draft on the 1st of the month, whatever it is. Make it easier, number one, for you to collect and for your clients to pay. And then also what you're doing is you're making it more predictable making your cash flow more predictable for you. So pay vendors slower. When we think about that cash conversion cycle, we actually get a benefit in the cash conversion cycle from paying vendors slower. This is especially important in a time of crisis for a few different reasons. Number one, if you've got loan payments for cars, trucks, if you've got mortgage payments that you can defer, do that if you can in a non-harmful way, and that's going to depend on your lenders, and that's also going to depend on the terms that they offer you. But do that if you can. The other thing you've got to realize, though, is that your clients are going to be doing the same thing to you. So that's got to go into your cash forecast. And the other piece of that too, though, is that some vendors offer discounts. So you've got to do some what if analysis to kind of figure out, well, should I hold the cash and pay slower, or if I get a bigger benefit by taking a discount? Depends. You've got to do the math for yourself, and that's the kind of thing you got to be thinking about. Ask vendors for discounts. Realize that this is going to happen to you, but also that you should be asking your vendors for discounts, especially if you've been with them for a long time, if you buy huge quantities. If there's a replacement vendor that you could potentially go to, just say, hey, look, I would like a discount. I want you to match a price or whatever it's going to be. They say no. It's like, okay, and just go to a different vendor. Ultimately, you've got to do whatever's going to benefit your business and your employees and your family the most. And if that means going to a different vendor, that means going to a different vendor. And then finally, don't be afraid to dig into the transaction level detail of your P&L. That's part of that whole cash flow forecasting process that we went through, is figuring out exactly where the cash is going out, figuring out those vendors, those subscriptions that you're paying for, that's cash going out the door, and really kind of taking a good hard look. Do I really need this? Do I really want this? How is this affecting my cash flow? Positive, negative? Do I need to get rid of this? I'm putting a new process in place. I'm going to take on this new subscription. Really dig into the detail and figure out exactly where your cash is coming from and where it's going to, because ultimately that's going to make you a more informed business owner, and that's going to really inform your processes and your procedures and your success going forward. So, and one of the best ways to think about that, subscriptions, software subscriptions, always the low-hanging fruit. You have software subscriptions that they're duplicative, they do the same thing. Get rid of those. It's really easy to sign up for software nowadays and just put your credit card in and charge you $9.99 a month, and no big deal. It's $9.99, except for when you actually need cash, then it's a big deal. So that is pretty much it for me. We're almost up against the full hour, and I know that was a ton. Any questions, by all means, please do put those in the chat. Happy to answer them. The Don Ryan Center sent out that cash flow forecast template. I believe it was earlier today. So please do look at that. Please do forecast your cash in your business. It is a super important process to go through. And it's really, really informative, super helpful. Can't think of anything right now that's more helpful than doing that. If you have any problems with that forecast template, by all means, just send me an email, chris@betterwaycpa.com. We're happy to help. We're not charging anybody for those types of things nowadays. We're really just trying to be as helpful as possible. So without further ado, that's pretty much it for me, unless anybody's got any questions. Okay, I don't see any. So Lindsay, I think I can pass this back to you. And Lauren, you're very welcome.
All right, thank you, Chris.
Absolutely.
All right, thanks. See you all. Our next Zoom meeting is this Thursday. Check out Don Ryan Center's Facebook page for more information.
Thanks, everybody.